Is a recession finally here? Well, today it was announced that first quarter GDP in 2025 was negative for the first time since 2022. The US economy allegedly shrunk by 0.3%, and it's important to remember that this is an initial number and these numbers will always be revised months down the road. As a matter of fact, when GDP was negative in 2022, that was later revised to be positive. So take these numbers at what they are, but with that said, let's dive in a little bit deeper to discover, is a recession actually here, or is this just smoke and mirrors? So a lot of people are jumping to conclude that Donald Trump himself, the president of the US, if you're a foreigner, is causing this recession or causing a recession. And it's actually kind of funny because economic data has been souring for well over a year, way before the 2024 election. And it's just a coincidence that Trump has decided to implement his trade war 2.0 policy at the same time that economic data is not faring very well. It's not his fault per se that the economy has been trending towards recession for a while, but he is sort of exacerbating the problem by implementing these tariffs, by decreasing government spending. Those are two huge components of US GDP and some of the other metrics that measure how well the economy is doing. So there's a lot of good stuff you can read about in this article, but let's jump over to a chart, something more visual. You'll see here how the different components of GDP are laid out. You've got consumption, exports, investment, imports, government expenditures, and you'll see how the colors here over time, how different aspects have changed US GDP for growth or for contraction. And you notice you fast forward to the first quarter of January 2025, and you'll see that consumption, although it's slowing down, it's still technically growing. This is all percentage of growth. So you see it's the growth of consumer spending is much smaller than it's been. However, investment grew a lot. I want to say a little over 3%, actually almost 4%. Exports grew compared to the last quarter. Imports exploded, and then obviously government expenditures contracted. So Trump and his administration have been doing a lot to cut back government spending. That's not a surprise. But the fact that this much, or imports grew by this much to get ahead of the tariffs is quite crazy. So what that tells you is that businesses have the money to increase inventory, to invest in their business, to get ahead of these tariffs, but they're not struggling. Does that make sense? Like, they have the money to sort of be preventative, be proactive. So they're not struggling from that standpoint. But you see that this imports number drove down US GDP growth for the first quarter by a lot. But when you look at the economy, it looks fine. Like, private investment and consumption is growing larger than it has in any quarter since 2023. So in that sense, it's fine. I think it's just literally Trump and his tariff rhetoric has sort of caused this panic, has caused this uncertainty. And that is what the market hates the most. It's not contraction. It's not recession. It's uncertainty. People will pull money out of the markets when they don't know what's going to happen. If they know when bad times are going to end, they will just wait them out. But if there's uncertainty, people don't want to deal with that. They want to get out. They don't want to mess with it. They want to wait until there's more certainty. So let's look at a different chart to get a better understanding of some other economic data. So that was US GDP, but this guy on Twitter claims that real final sales to private domestic purchasers is a much better indicator of how the economy is doing, because this is strictly private investment. This is consumer spending plus private investment. The actual growth of private investment and consumer spending has actually been pretty steady since about Q1 of 23. So it's not quite as large as it was post-pandemic, but holding up fine. Actually increased a little bit slightly from the prior quarter. Here is another chart that shows the growth rate of GDP over time from quarter to quarter. And yeah, you can see, I feel like if we didn't have this whole import scare, it would be up there. It would be like 2.5% probably. But you can compare it to the real final sales to private domestic purchasers, and you can see that grew more than in Q4. And once again, has been fairly steady. So let's hop over to consumer sentiment, because typically when the economy rolls over, consumer sentiment actually is typically the last thing to sort of go down. Typically everything's front loaded to that, and then consumers sort of react after everything else has happened to go pessimistic. So you see today, consumer sentiment is really kind of low. I mean, it's not as low as it was in 2022, when that was sort of in the middle of those back-to-back quarters that at the time were labeled as negative GDP growth. But it's as low as it was in 2011. There was a little bit of a scare there, but it's as low as it was during the Great Recession. Didn't even get that low in the early 2000s recession. But yeah, I mean, consumer sentiment, typically when it gets this low, that indicates that the bottom is in, or the bottom is fairly close. So the fact that consumers are this negative already really says to me that, maybe things have actually already run their course. Because I feel like most people have only been talking about recession for the last couple months. But if you paid any attention to the economy over the last year, you'll know that really, like I said at the beginning, economic data has been souring for over a year. Auto loan defaults are at record highs. Credit card debt is the highest it's ever been. Layoffs have increased. The unemployment rate has increased at a rate typically coinciding with a recession. Those things all happened over the course of the last year, but people have only talked about recession recently because the stock market rolled over. And the stock market typically is 3 to 6 months in advance of the economy. So if the stock market rolled over in December, we would expect between March and June for the economy to have its first contraction, which we've allegedly had here, but it appears to be self-induced. So when I look at these numbers, I really do think that maybe this is it. Maybe we move sideways for a little bit, but we've been doing that since 2022. So a lot of interesting trends there, but you can see, typically when it's at this low, there's a recession. So it's kind of surprising that, we're this low with consumer sentiment, but there's been no recession. I think part of it is that it's been inflation. I think the private economy outside of government spending has actually contracted in terms of nominal dollars, but when you add inflation, it makes it seem like the economy's actually grown. Well, it's not been the case. And I mean, if we can just hop over to some charts, I know technicals aren't economic data, but you look at a Fibonacci sequence, which if you don't know what Fibonacci levels are, Fibonacci is a ratio that is found in nature. It's found in flowers and trees and even in human behavior, which is what the stock market is. So there's tons of videos about it. We can talk about it another time if you want, but you'll see that if we go from the most recent high, most recent low, we pull the chart back up to the most recent high, you'll see that the level of 1, which is typically the first major level of support or resistance, we came down right there. We retested the old high basically in the S&P 500. If it goes down to 1.618, which is the golden ratio, that's typically a stretch. I mean, I would think things would have to get really bad for the market to get pushed that low. But see, we're already there. That's my point. We're already there. We've already reached the level of 1. This could be the bottom. We could move sideways for a little bit. We could chop. We could go back up. We could go back down. It could be, 6 months to a year before it decides to start going back up again. But the rest of the year could very well be sideways movement. We've already contracted, over 10% from highs to low. And that's quite a lot. That's actually a lot in the S&P 500. And if we compare that to 2008, and we do the same thing, okay, this was the high in October of 2007. We go down to the low in 2009, March of 2009. Obviously we went a little bit deeper, but still held up around that level. So even though the S&P 500 contracted for over a year and a half, or almost a year and a half, it still only hit that Fibonacci level of 1. So the fact that the S&P 500 did what it did in about a matter of a month in terms of how much it declined, I'm very suspicious, I'll say it that way, that the bottom may be in. It really depends on how resilient consumer spending is. So let's hop over to some consumer spending stats. I have some charts pulled up with some valuations of the S&P 500 as well. You can see it's still kind of quite high. You can see it's still sort of elevated. Investors typically step in around 19 in terms of the PE. Sorry, this is the PE ratio for the S&P 500. Typically when it bottoms, it hits about 19. We're not quite there yet. But the problem with valuation metrics is that it is so hard to gauge what a proper valuation is for the US stock market today. And I know every time somebody says this time is different, it's not. But tech companies make up a larger percentage of the economy than they used to. They grow much faster than traditional companies do because of their asset-light business model. And U.S. companies are more profitable, at least now. So if that were to change, who knows what would happen. But basically what I'm saying is that a higher valuation for the U.S. stock market is worth it. Or I guess you can make an argument that it's worth it. But anyway, let's hop over to some consumer spending trends. So this is the total outstanding credit card balances. And obviously we're really only looking at the chart from about 2020 to today. So about right in this area. And you can see it's just exploded. And I checked this article. This is not adjusted for inflation. So maybe you can contract the chart a little bit. This is in nominal dollars. And this is outstanding balances. So this is how much people have on their credit card at the end of the month. It was the highest it was in 2019 going into 2020. But then once the stimulus checks kicked in towards the middle of 2020, you can just see it's exploded. And to me, the stimulus checks made up a lot of consumer spending. And then people spent their saving. Then they lived paycheck to paycheck, and now they're living off their credit card debt. That's sort of what I think has happened here. And how long is this trend sustainable? I have no idea. And the other thing to keep in mind as well is that, I mean, you see the outstanding balance is only about $1,200. Consumer spending of households like under $175,000 in a household income only account for less than 50% of consumer spending. So the vast majority of consumer spending is by high-end consumers, and their income more relies on the stock market and their assets. So their income is more tied to basically asset prices. So this only tells one part of the story, and sort of my question over watching this the last couple of years, or last year or so, is that how much does the low-end consumer struggling impact the broader economy? That's what I'm not sure about. And if it does, how long does it take to trickle up? Because capital expenditures, especially on AI, have continued. Consumer spending is still growing. It's slowing, but it's still growing. I've not done enough studying to know how much this actually impacts things. The car market has been in recession for a very long time. I can't think of how long it's been exactly, but it's been at least 2 years. So basically, new car sales has contracted or has decreased over the last 2 years. And the auto industry has faced numerous challenges. But new cars have just gotten expensive. They've really increased out of COVID. Car insurance has exploded, which I think is actually a larger driver of new car purchases than anything else, or at least more than it gets credit for, because car insurance on a new car is just insane compared to what you get on a used car. Talking about thousands of dollars every 6 months in difference in cost, especially for EVs. EVs are very expensive to insure. But you can see prime borrowers, so this is like the higher end consumer I was talking about. This is people with good credit. This is auto loan delinquency 60 days plus. They're fine. Now, I'm not sure how... January 2025, that's how far this goes. So this is sort of before the stock market rolled over. I would be really curious to see in the next couple months if this spikes more as the higher end consumer loses their purchasing power due to their asset prices going down. Subprime though, once again, low end consumer, this is less than desirable borrowers, highest ever recorded in terms of auto loan delinquencies. So this is another metric that shows you that the consumer is really struggling and their spending power is decreasing, which eventually consumer spending is going to slow down. And as we saw on that chart, consumer spending is a very significant portion of US GDP in terms of growth. Private investment was a huge part of it that quarter, but look at a couple quarters ago. I mean, all the growth was consumer spending. So, I mean, if the consumer really slows down and struggles, things are not going to end well. That would be a recession. But I would keep an eye on that. As long as consumer spending stays positive in terms of its growth rate, then it'll be okay. But well, I have tons of things I could cover. I would love to talk about some other stats and as it pertains to macro data. If you're interested in that, please let me know. And if this video does well, obviously I'll take that as a signal that I need to make more of these kind of videos. But this has just been sort of a preview of some of the data I've been watching for the economy. If I had to give my honest opinion, if you asked me a year ago, I thought there was going to be a recession this year. Just based off the way the data was going, the fact that everyone was so bullish on the stock market, even though that's how bubbles form. And my biggest takeaway is that because asset prices have increased so much and wages have not increased as much, that you're basically building up an asset bubble where everything's really expensive, but all the wealthy people have all the money, and the people who spend all that money don't have any money to spend. Therefore, decreasing consumer spending, leading to recession, and then the government has to step in and sort of redistribute wealth to put the economy back into balance. That's kind of what I thought was going to happen. I think it's still trending that way. And obviously with inflation, which is something we didn't talk about, the Federal Reserve really has no tools to combat the unemployment rate if it were to rise significantly, because it's still only around 4.5%, I think, maybe 4.3%. It's not very high. And actually, while you can blame Trump for the whole tariff battle, his crackdown on immigration and the slowdown of immigration, while long-term is not good for the U.S. economy, in the short term, it's preserving the unemployment rate. It basically is capping up the labor force and saying only this many people are entering the labor force. But anyway, we can discuss that more in another video. Let me know if you like this. I'm going to stop it here for now. Thanks for watching. Have a good day. We'll see you in the next video.